Right. Welcome. It's 6 o'clock. Welcome to the Tideway webinar. I'm James Baxter. I'm going to chair the session this evening. I hope you all know who I am, and I'm joined by Nick Gate, Investment Director, and Ben Klein, one of our senior wealth managers. On Tuesday, um, with the markets quite heavily down, and a risk-off kind of motion on the outbreak of war over the weekend, TS Lombard had a fairly upbeat message, really, which was that they figured it was going to be a relatively short affair, and so they offered a call with Chris Grenville, who's their main guy on this stuff. He used to be a diplomat. He was at Barings for a couple of decades, and he's pretty senior guy and knows his way around these sorts of things. And he had some very good arguments as to why um, the conflict would be relatively short-lived. And his analogy, which I'm going to try and use now for all these scenarios, was one of a gardening scenario, actually, a gardening analogy. So he talked about a weed in the garden. We've all done this. It's quite easy to chop the top off and look like the weed is gone. But what that does is leave the roots still in the ground, which obviously means it'll come back up again. Now, in his scenario, he felt like they were quite quickly going to get the top off the weed. And for the weed, we're talking about basically the incumbent regime in Iran, if you like, who were a nuisance in the region. So his scenario was the top of the weed would be off, the decapitation, as we've been hearing, and then the bombardment to flatten it down so it's pretty much invisible to the naked eye, but it's still there underground. And then he felt that that would be sufficient for Trump to declare victory in the war, the biggest victory ever. So that's where we're at. Now, the good news is that it so far hasn't been anything. We sat here a year ago after Liberation Day and we were already down 10 or 15%. And as Ben can now show us, and he's going to talk us through the impact over the last week, we'll see that so far things are not anywhere like that. So, Ben.
Thank you, James, and evening, everyone. So obviously it's been a pretty poor period geopolitically, but for markets at the moment, it's far from a disaster. So hopefully you see the chart in front of you there, which shows you three sort of simple lines. The top one, A, is just our pure sort of low to medium risk fixed income only portfolio. Some of you may hold this in your ISAs, kind of a popular portfolio for the ISAs. B is our multi-asset balanced portfolio, which is our kind of medium risk, typically within pension funds, I guess. And C is our equity only portfolio, and that equity combination makes up the equity bucket of our multi-asset portfolios. As you can see, this is just how those three portfolios have performed this week. Clearly, they're all negative, which is a little bit disappointing that markets have correlated like this. But as you can see from the numbers on the left-hand side, we're only talking, you're down 0.5% on the fixed income portfolio, which is far from a disaster. And even on the multi-asset or the pension fund money, I guess you're looking at a 1.5% loss at the moment. Again, far from a disaster. So, this is going to take this into a slight bit of context here of, yes, things could get worse. And even today, we're seeing the US markets rolling over again slightly. So things could well get worse. And as James said, this may continue for some time. But at the moment, it's, as I say, far from disaster. It hasn't been great, but actually it's not the end of the world.
And whilst we've got that slide on, Nick, you quite rightly mentioned the fact, Ben, that the fixed income bonds have gone down in correlation with equities. Do you want to just explain why that might be happening, Nick?
Well, the main reason is the inflation scenario. Obviously, reduced supply of oil, and demand stays roughly the same. Therefore, energy importers will largely have to pay more for that, which has it's an inflationary effect, a knock-on effect on the economy, and broadly in fixed income, where your returns are fixed, as it sounds. I mean, greater incentives are required for people to invest. So the yield curve at the long end, the term premium, as it's known, increases. And at the short end, all the rate cuts, which were previously priced in by the market, the market is now less certain. So
it's really about inflation creeping in.
yes.
I guess you've probably seen oil prices have been rising. They're up again 5% today. Oil prices obviously feed into inflation a lot. And probably what we've seen as a sort of first thing is that the interest rate cuts that were kind of penciled in by the market for this year are probably being pushed back as we speak, because without prices coming down, it's going to be harder and harder for central banks to keep dropping interest rates. So that's kind of the fixed income outlook. And also, I was quite keen to point out here the fact that, on the fixed income, okay, we're down 0.5%. I mean, that's probably about just over 1 month's worth of interest. So recovery time on that portfolio is going to be, 30 to 60 days.
And this chart here is again, it's the same 3 portfolios, but over the last 3 months. So it spans from the back end of last year and this year. And as you can see, on the far right-hand side of the chart there, clearly these portfolios have rolled over slightly, but frankly, it's only taken our clients and their portfolios back to early February, roughly, of where the values were. So yes, it's been clearly a negative week so far, and things could get worse. But on the back of a pretty decent 3-month performance, and frankly, an outstanding 3-year performance, but actually, again, you see a far smaller blip in a 3-year return. So,
I mean, one of the things I'd like to just ram home here, just looking at that slide, is, obviously you can see we've been rewarded for equity investing for the last 3 months, but clearly with equities, there is a much greater uncertainty about what happens next. But one thing is for sure is that we do have very nice 3-year return numbers at the moment, and therefore, whether you're with Tideway already, or you're thinking about using Tideway, or you're working with private clients managing their money, now has to be a great real-time opportunity to do a good old risk assessment with yourself or with clients to see, have you got the right, do you own the right assets? I mean, we're always susceptible to 40%, downswings, 40 or 50% downswings in equities, whereas in the bond funds, a 20% fall would be absolutely right at the edge that we had in 2022. We're not expecting anything like that at the moment, given the starting position. And the recovery rate in fixed income is so much more rapid, whereas in equities, the recovery could be a decade. And as we all get older, for us who are getting a little bit older, not that much older, really, but as we get older, 10 years is quite a long chunk of our lives in front of us, and therefore, how long do we want to spend seeing our portfolios recover versus, spending what we've got? So I would say, this is a great opportunity to rethink. We track the portfolios in FE Analytics, and every time we make a change to the portfolios, we get a spot on the chart. FE Analytics records the fact that we changed them, and that's how we can now look back and see what we've done. And Nick is going to talk us through 3 main changes that we've made in the run-up to this before we got hit by the news on Saturday.
Yeah, perfect. Thank you, James. Thank you for outlining all the narratives and scenarios there. As you can see, there were more than one of them, all from well-resourced and well-informed institutions. But given the lack of crystal ball and the most likely outcome doesn't always happen, we think, changes are always best made from a portfolio perspective in the good times rather than the bad times. So we have a few of those which we can have some examples which we've implemented over the last 12 months from all of our asset classes. So the most recent one of the most recent ones is in the alternative space, where we added to our absolute return allocation, the new fund being Trium Alternative Growth, with the idea of that fund is that it performs strongly when markets are negative. So going in the opposite direction to...
and has it gone up now?
It is flat so far, but I would add that the intention is
not to lose money.
Yeah, the best performance is seen in largely negative markets, and as Ben showed on those slides there, US equity markets are not off more. Well, equity markets as a whole are not off more than 3% in aggregate. Yeah. So you need to see bigger moves for the payoffs there. So the idea with that fund, in large risk-off market stress events, that makes money. and that sits alongside our current incumbent, Rougher Diversified Return, which also has a similar mandate.
And those two funds are in all the mixed asset portfolios.
So the Rougher fund is in all the mixed asset portfolios, whereas the Trium fund is in just our lower risk multi-asset strategies. We also de-risk, in our opinion, our fixed income allocation. So we resisted the temptation to add duration as the yield curve steepened due to inflation concerns and the effect that may have in the short term on portfolios. Given inflation shocks like this, obviously yields or fixed income is going in the same direction as equities. So adding duration doesn't help you; it adds risk rather than takes it away. So we kept duration short, and we also reallocated our portfolios to those managers who had protected capital best in previous downturns and or recovered the fastest. Also important to note here that within the equity portfolios itself, they were rebalanced. So in that scenario, in that dynamic, the best performing equity funds had their weighting reduced, whereas the funds which struggled were topped up, and that's actually prior to this market environment was a good move to have made. Those are all the changes in the last 12 months.
Good. So just to refresh,
so
we did alternatives, extra alternative fund.
Yes.
We've done
consolidated the fixed income,
made the fixed income a bit more resilient for a downturn,
and
we've rebalanced.
Yeah.
You had some numbers on our top performing fund of what it meant.
Yeah. So
it's basically sold when you rebalance. You sell the funds that have done best, right?
Exactly. So the top performing fund done fabulously over both 2024 and 2025. I won't name the fund, but I'm sure some of you can work it out. Of our total position, without changing the target weightings due to the outperformance, it had the effect of reducing the weighting by 20%, which would be, depending on your portfolio, reallocated into other lesser performing equity funds or lower risk fixed income.
They want some of it. Right, Ben.
Yeah, so we just thought we'd wrap up on this tonight on just some clearly some end of tax year work that's we're doing with clients at the moment and things to think about. A lot of this isn't particularly rocket science, I'll be brutally honest with you, but it's just sensible planning that can see you in good stead. So the obvious one being ISA contributions, £20,000 per person. Obviously, clearly for a couple that's £40,000, and you can do the same earning in the new tax year as well. Small added to that, you can clearly contribute to a junior ISA on your child's behalf, perhaps. The limits are slightly different there at 9,000. And also with flexible ISAs, AJ Bell, who we use for ISA provider, they have flexible ISAs. So if you've taken any money out of your ISA during the course of the tax year, you can then reinvest back into the ISA. So let's say to 10, 12K out, you can put the same back in. So that's worth doing if you can. And then going on to pension contributions, the rules are a little bit more complicated than I've outlined on this very basic slide here. But again, it's worth making a contribution if you possibly can. The limits do vary depending on how much you earn, but very simply speaking, you can contribute up to 100% of your earnings to a maximum of £60,000 gross. That's you and your employer, perhaps. But for those who are higher earners, and even the term higher earner is overly complicated. So to keep things simple, if you earn a sizable amount of money, that limit could reduce down to £10,000. Your wealth manager will be delighted to go through the intricate details of those rules, but it is relatively complicated. But essentially, if you can make a pension contribution this tax year, it's been worthwhile doing so. And also, if you haven't made contributions in the previous tax years, you can go back 3 tax years to do this as well. It's worth potentially, especially if you're perhaps heading towards retirement and this may be your last year or your penultimate year of making some decent pension contributions, this would be a decent thing to do. So you could end up putting a sizable amount into your pension, getting a decent amount of tax relief, hopefully some tax-free growth and a bit of tax-free cash on the back end as well. And even if you're not working, or you've got children or grandchildren potentially not working as well, anyone can make a pension contribution up to £3,600 without any evidence, so to speak, of any earnings at all. So those who are maybe retired, or spouses, or children, or grandchildren, you can make a decent contribution into those pensions. And then going on to just simple basic income tax. For those of you who've got a pension fund, perhaps when you haven't taken any income this year, it may be worthwhile considering doing so, using up your personal allowance, using up the basic rate band, 50k or so, or even up to the 100k mark. We won't talk in depth about inheritance tax planning tonight. I think we've covered that in the past, and we're happy to do that on a one-to-one basis. But if for those clients with more sizable pension funds, you could argue taking out 100k a year is a reasonably tax efficient way of getting money out of your pension, and using those slightly more generous allowances rather than going into, as it says on the slide there, that 60% effective tax rate of income between 100 and 125. So even though you may not need all of this income, you could take some income out of your pension. And then, as the next slide will go on to, about in terms of gifting some of that money on, or you can then recycle that back into ISA contributions, or perhaps pension contributions for spouses or children or grandchildren. Again, a lot of this is relevant for the particular client, so I'm being very generic here what I'm describing, but essentially taking these examples will be useful. Then moving on to capital gains tax. Probably we're in a nice position over the last 2 or 3 years where there are gains to be made and there are gains to be taken. Sadly, the government have reduced these allowances year upon year, it feels like, and so it's sadly only £3,000 per person of a capital gains tax allowance. But again, that's worthwhile using. So we do it most of the time for our clients. We would take that gain for clients within their general investment account, and then that'd often be money that we can then use for ISA contributions in the following tax year. Fairly straightforward stuff, but it's worthwhile using that gain because you can't roll that gain forward to future tax years. I touched upon the IHT point just now, but again, a measly annual allowance there, but a £3,000 allowance you can make to that it doesn't suffer any inheritance tax, it doesn't form part of your gifting. So that's worthwhile doing if you can do so. Again, touched upon, pensions will form part of your estate for inheritance tax purposes. It's just over a year's time. So all of this is worthwhile trying to, broadly speaking, get money out of your pension fund. Again, case by case, of course. And then consider gifting on a lump sum basis. Obviously, you have to wait the 7 years, generally speaking, for that to fall outside of your estate, or gifting regularly out of excess income. And those regular gifts, that falls outside of your estate immediately. Without going into the details of that, that's a nice way, in conjunction with taking money out of your pension, perhaps, of being overall tax effective through income tax planning and inheritance tax planning in the future. Again, that's fairly basic and fairly straightforward, but it's worthwhile if any of those things you think are relevant for you, contact your wealth manager. And there is time before the end of the tax year, but please don't leave it to the last minute. And then the final slide we have on this is what is changing post in the new tax year. The short answer is not a lot, quite frankly. Obviously, a lot of these allowances have been frozen, as we've touched upon in the past. And the bullet points we've got on the slide there, which hopefully you can still see, is these are pretty niche stuff for clients. So again, I won't go into detail, and I effectively will leave the slide on the screen there. But there are some changes that are happening which may affect a small part of our client base, but these are the areas that are changing. Again, if any of these are particularly relevant for you, without going into huge detail on any of them, the classic contact your wealth manager, they'll be delighted to chat it through with you.
The biggest thing that we've all got to get right is to get the planning right ahead of these events, or certainly it's not too late at the moment, given the fact that we've only handed back 2 or 3% at the moment, on the back of returns of 30-odd% for the last 3 years. It's a great time if you haven't got enough liquidity around you to see you for the next 5 to 10 years, then take some profits and make sure that you've got it, because one of these events is going to have a much longer recovery period. So far, in the last 5 years, all the markdowns have been recovered almost within a 12-month period. But at some point, we're going to get one that's going to take longer to recover. Is it this one? We don't know. And it's then when you've got to make sure that you've got enough liquidity so that you're not selling equities at a loss in order to fund your lifestyle. And that's our job as planners, to work with you and the individual wealth managers like Ben to make sure that that doesn't happen. I mean, the two big things that I've seen in the last couple of weeks is clients coming to us who are massively overweight in property, who haven't got enough liquidity, and have never done enough saving and liquid investing of the type that Tideway does, which is always a problem. And then some people coming to us with way too many equities in their portfolios, who are older and who really don't need to take that much risk in order to earn a premium return above inflation. We have to keep reminding ourselves that we can earn good returns above the rate of inflation without having the equity risk. And it's the equity risk which is going to get pushed around by this action. The bond market will be a little bit volatile, and will undoubtedly move around a bit. But every time it goes down, the yields go up, and so we end up back in the same situation, and we'd expect recovery to be months, not years. If we got a very big, long, drawn-out scenario in equities, we could be taking a multiple year period to recover from it. So thank you very much. I'll try and cover a bit more in the update tomorrow for everybody, and then wish you well. Thank you very much.